Most traders pick a micro contract the wrong way. They either copy what they see other people trading, or they just jump into one that moves the most. And that's one of the quiet reasons so many people keep failing prop firm accounts. Today, I'm going to break down the three main micro contracts that actually matter for futures prop firm trading right now: MNQ, MES, and MGC. So, not just the basic specs, I'm going to show you how each one behaves inside a prop firm account, especially when you're dealing with daily loss limits, trailing drawdowns, and the need to stay alive long enough to get paid. So, this is the kind of decision that can either protect your account or quietly kill it over time. So, let's start with the basics so everyone's on the same page. The three contracts: MES, MNQ, and MGC. So MES, tick size 0.25 points, tick value $1.25, point value of $5. So this is a smoother, more controlled equity index contract. MNQ, tick size 0.25 points, tick value 50 cents, and point value $2. So this is the faster, more aggressive one. It moves more in points even though the tick value is smaller. MGC, tick size 10 cents per ounce and tick value of $1, point value $10. So this is the non-equity option, different personality entirely. So now let's talk about how these actually feel when you're trading them on a prop firm account. MES, the controlled option. So MES is what a lot of experienced prop traders default to when they want longevity. So it doesn't whip around as violently as MNQ. The daily ranges are generally more contained. You can place a structure-based stop without it getting hunted as easily. So the trade-off is simple. It takes more points or more contracts to make the same dollar amount compared to MNQ. So if your main goal is surviving the drawdown and staying consistent over time, MES is usually the safer environment. A lot of traders who struggle with overtrading find MES helps them stay more selective because the moves don't constantly scream at them to get in. Let's go over MNQ, the high movement option. MNQ is where most people get attracted first. It moves more, it gives bigger point swings, and it's my personal favorite. On a good day, you can reach a profit target faster with fewer contracts. But here's the part a lot of traders underestimate about MNQ. Because NASDAQ moves harder, the same stop and points cost more in dollars relative to the account's risk limits than people expect. So a stop that feels normal on MNQ can eat a surprising percentage of a trailing drawdown or daily loss limit. MNQ rewards traders who are already selective and disciplined. It punishes traders who force trades or size up too quickly. So if you like momentum and you're comfortable with higher volatility, MNQ can work extremely well for you. If you're still working on consistency, it can accelerate both wins and losses. Let's go over MGC. So the different personality. A gold is a completely different animal. MGC doesn't follow the same equity session flow. It can trend hard on macro news and then go quiet. So it reacts to different catalysts than the indexes. The tick value sits right in the middle at $1. Some traders like MGC because it feels less correlated to the stock market. Others struggle with it because the rhythm is different and the overnight risk behavior is different. For pure day trading inside prop firm rules, MGC can be useful as a secondary market, but it requires its own set of rules. You can't just treat it like a slower MNQ. How do I think about choosing between them? Here's the practical way I look at it. If the priority is survival and consistency on a prop firm account, MES is usually the cleaner starting point. If the priority is more movement per contract and you already have strong selectivity, MNQ can make sense for you. If you want non-equity exposure and understand gold's personality, MGC becomes an option. The biggest mistake I see is traders choosing the contract based on how exciting it looks instead of how well it fits the risk limits of the account they're actually trading. So your daily loss limit and trailing drawdown don't care which contract is more popular, right? They only care about dollar risk. So that's why contract selection is a risk management decision first and a preference decision second. One more important point. A lot of traders switch contracts mid-evaluation or after a few losing days. That usually makes things a lot worse. So each contract has its own rhythm. So jumping between them when you're already emotional is a fast way to create new mistakes. Pick one primary contract, learn its behavior deeply, and only expand later if it actually makes sense for your process. I have a really quick question for you before we kind of wrap up. Which micro are you currently trading the most? MNQ, MES, or MGC? Has it actually been helping your consistency, or has it been making the account more stressful? Drop it in the comments. I actually want to see like what most people are using right now. So if you're looking at futures prop firms, two that I personally use and recommend checking out are Bulenox and Top One Futures. Bulenox has been making some strong updates this year, so you can use code UP for the current best discount. Top One Futures is another clean option. Use code UPT for the highest discount available right now. Links are in the description. Trade clean.